And joining us now for a look at the investment in the insurance space is Nkareng Mpobane. She's a portfolio manager at Ashburton Investments. Nkareng, thanks very much for joining us. Well, we've seen the likes of Sanlam, Old Mutual trading at robust highs, and a lot of people out there are saying, is there more upside to the insurers?
I know, so the premiums price to EVs have been particularly high when you especially look at something like Discovery and Sanlam being the two highest price to EV multiples. But we do believe that where the South African environment is seeming somewhat muted, it could be supportive for the industry overall. So it depends which segment you'd be playing. So the higher end, we think the drivers there would be interest rates and GDP growth, whereas so nominal GDP, and then in the lower end, the drivers there would be inflation and employment. And we currently preferring to stay with those insurers that have a bias to the higher segment, because we don't see a very aggressive interest rate hiking environment, and provided that nominal GDP remains above 8, so at an 8.5 level, we think that that should be supportive.
Well, Edward, we're going to get you to weigh in a moment. Lindsay, I know you've got a question. Of course, we've got the guru in studio here himself. I know Nkareng's a little cautious that he's sitting to her left. Lindsay.
So many questions, yeah, but just before we get to the nitty-gritty, how much of the current elevated share prices, Nkareng, are to do with the elevated level of the JSE Securities Exchange, and how much is it to do with the fact that these businesses are doing rather well, thank you very much, within their own space?
So would probably agree with you, Lindsay, in that in the short term, the short-term drivers have definitely been market performance, driven quite strongly by foreign shareholding in these companies. So Old Mutual obviously has quite a high foreign shareholding. Even when you strip out the strategic holdings, you're probably seeing levels of around 50–55% in the foreign shareholding space. And you've seen foreign shareholders starting to, you know, they're talking about the carry traders back on, and emerging markets benefit somewhat from that. And definitely in the short term, the insurers have probably been driven by strong market performances. But on a longer term outlook, sure, we would need to see the fundamentals coming through. And I think that's where Sanlam has also benefited, where Sanlam operationally, with their diverse operational earnings, the market has supported that strategy quite strongly, because it presents defensive qualities with it.
Edward, has she got it spot on?
I think you raised one important point, Nkareng, the issue of fundamentals, because we get lost in the glitter of share prices.
Sure.
And the issue really about sustainable growth has to talk to fundamentals. South Africa is a safe place to be in if you're an insurer, but we also know all of those big insurers look for growth. And the opportunity for growth is outside of South Africa, in a world that is increasingly interconnected, driven by technology. We see the shifts in social dynamics with people uprising in our own place. We see that, but we've also seen it elsewhere in the world. We see a shift from the developed economies into high-risk economies where the growth happens to be. What is your view? The sense is that how long will this buoyancy and this exuberance around share price last unless those fundamentals and understanding how to embark on those opportunities beyond our borders are tackled? What advice would you give?
So I think one of the points you raised is very important in understanding the territories and the regions that one would move into. And I'll raise Sanlam again in this instance, in that it has embarked on an emerging market, which you might see as high-risk regions. So emerging market, we're talking Africa, we're talking the Far East, we're talking India. And it's about really understanding these markets and economies and how they work, and just the regulatory environment of business, as well as the retail client in these regions. So being very cautious, obviously, and probably, so Sanlam doesn't necessarily take incredibly massive stakes in the companies that they acquire or get into agreements with. So we're comfortable with that sort of strategy, taking a small slice of the pie and growing that organically to become meaningful in your earnings over time. And we think that that's a strategy that all the other companies should look at. And we're definitely in a very interconnected world. And any company that might shy away perhaps from external growth, because you mentioned South Africa being a safe place. While it is safe, you might argue that the sector, so insurance, is somewhat mature. And growth needs to come from external territories, in our view.
That's my point exactly.
Yeah.
So to grow, you have to go. Through what lens would an international investor invested in a South African listed company look as they embark? What would turn off an international investor through the need for South African-based companies to go into the emerging market territories?
I think international investors seem to have been attracted to those companies with emerging market growth strategies, so expanding into Africa. And they seem to have shied away from those that are trying to expand into developed market economies, or would probably have a significant portion of their earnings focused in South Africa, because, as I say, you could pretty much see our financial services sector as a first world or developed sector somewhat. So a company that that comes to mind, for instance, Liberty, having recovered off the 2008 and 9 period and coming through quite nicely, we need to see a strategy of growth from Liberty into emerging market territories or whatever their stated strategy might be. But foreigners, I think the current view is emerging markets for them.
Just my last point. We've seen in South Africa underwriting losses going through the roof. Yeah. We've seen all of the insurers suffering as a result of that. Is it your sense that the tide is turning, the rates will harden, that fee cutting and rate cutting will stop?
It gets to a point where you reach a bottom in fee cutting and rate cutting, I would argue. And so with the underwriting experiences, the pricing right now, so you could argue from the second half of 2012, it was more about the negative assumptions and as well as so economic assumption as well as experience variances. Those were on a recovering base, and going forward we're going to need for the fundamentals, as I'd mentioned earlier, to start coming through in the earnings of these insurers. So I'm meaning increasing memberships and writing policies and growing the book. Where underwriting margins have come significantly under pressure has been the short-term space. I mean, you've seen the biggest short-term insurer even bringing down their target range for the underwriting margin. And we think that over the next 2 to 3 years, short-term is going to definitely come under some pressure.
Thank you.
Yeah.
Thank you. I like your views.
Thank you.
Thank you. Thanks so much. We've been enjoying this conversation. We've got to leave it to the experts here. Ashraf.
Just, you touched on Liberty, and that was going to be my next question. I mean, their stated target is growing into Africa and obviously on the backbone of Standard Bank. Do you think that is a workable strategy, or do you think they need to extend themselves further?
Separately, just looking at Standard Bank's footprint and how they're probably the envy of the banking industry in terms of their African presence. Yeah, I think there could be some synergies to be realized between the mutual and between Liberty, and Standard Bank, realizing those synergies. But I think the market is somewhat cautious in that we have probably been here before, where Liberty has mentioned that they'd like to see themselves piggybacking off Standard Bank's footprint in Africa. So I think the market is watching to see if it actually happens. But we think that yes, there's quite a bit of flesh that they could dig up out of that relationship.
Okay.
Nkareng and Edward, I want a sort of a joint answer here, because you're both experts in your field, as you completely isolated Bronwyn for the last 5 minutes with your excellent analysis. Let's have a look at the old school versus the new school, the old mutuals and the Sanlams and the Liberties versus the so-called upstarts, which are no longer upstarts, they're established players. It's changed the industry. It's been good for the industry or bad for the industry? Edward, maybe start with you.
I'm part of the school that believes that more competition, more players, just will be good for the industry, Lindsay. And so I think on the one hand you have these mature legacy players, as you've mentioned, but some of the risks of these is also some staid and some you lose eventually some of that edge. And I think what the new players are doing are forcing the traditional players to go back to the drawing board, to be more innovative, to invest for growth, to explore new markets. And so I think all in all, the market grows, but not only does it grow, the client grows because of better service levels and better pricing.